All right, a little rough start to the week here in the stock market. So we're going to break that down to see, again, is this noise like it's been? Or just more up and down noise? Is this the pullback? Is it not a pullback? More often than not, there's just so much noise. We get caught up in having a reason for why the market went up 0.5% today or why it went down 1% today. And the reality is when we're in the noisy period, especially at the end of a mature intermediate run, we just go up and down a lot. And these are the types of moves that we get before we finally get kind of the breakdown. The question is whether today is the breakdown or not. So I'm going to show you that in today's video as to what we'll now expect the rest of this week and going forward from here, how it impacts our intermediate expectations, whether or not we can buy this dip, so to speak. We're also going to take a look at a trade idea that's in an industry that's been doing very well in a sector that hasn't been, a sector that's been lagging behind. So now, will that industry be giving us signs about something more broader coming on? So we're going to talk about how to trade that with one of the bellwethers in that particular industry. So let's go ahead and get started. Today is Monday, May the 10th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So you can see the big drop that we had today, closing below the low of the high day. We actually get lots of those, so that's not that significant. There was one there, and there was one there, and there was one here. They're not that significant when you're on this bullish trend. And as of right now, this is pretty significant. The momentum line dropping to an oversold level. You can see we haven't had that to an extreme oversold level. We didn't have that until we start till right about here, post February expiration, and that kind of started the intermediate pullback. Remember, on the Nasdaq, not so much on the S&P, but there was some volatility here. But the Nasdaq, so that's a pretty significant drop. Unlike that period, the near-term line is still in the upper reversal zone. Both the intermediate and the market sentiment are also still in the upper reversal zone. Remember, we just like this day here that preceded that. We also almost came very, very close, like literally late day pullback that kept us from having an overbought cluster. So a big drop on the, then this is actually the best looking chart. Well, actually not the best looking chart. Here's the Dow, which did get the cluster there a couple of days ago. Long upper shadow on the Dow today. Again, very similar to what we saw over here pre-March pullback. There for the Dow. Temporary, very temporary. But, again, momentum line's not even oversold at all. The near-term line's still in the upper reversal zone. So that's the best looking market forecast. Here may be the worst looking one. The Nasdaq, which you remember had pulled back. Like, it's already ended this new intermediate rally it was on. Everybody else is still on the same one. The Nasdaq actually started a new one, and it's already pulled back and broken the 23% retracement level of that move. And is now broken below the lows of last week, breaking well below the 38% retracement level of that move. You notice we never did get above the 23%. If I were to kind of draw this line here and put it with the other low point with everybody else, the other intermediate runs that all started here in November, you can see we are right on the 23% retracement. So, if it didn't have the actual intermediate pullback, we would be really close to actually beginning the intermediate pullback that we're kind of expecting in all these other charts. So, but remember, it did, so I have to move that there to this line, to that low point there, and there you can see breaking the 23% retracement level. Actually, I think I might have had this one. Looks like it was over here when we started the rally. There we go. Started the rally there, because we didn't start the intermediate run there. We had some more weakness. This is where we started the run, but that move off that low point, again, similar to that move off of this low point and not this one, right? Because we didn't start the intermediate run off of that low point. We started it off of this low point. That's why the lines would be drawn there. That's where they are drawn on the S&P. You can see there. And then, of course, the Russell 2000, which doesn't look as bad because it's still very, very sideways, but still, that's a very extremely low momentum line again. And now the near-term line setting up for a bearish near-term high point, which would be a lower high, and the intermediate lines coming back down close to crossing back below its its market sentiment, and also breaking below the 50 line. So obviously a lot more significant bearish patterns. If you look at like the directional movement index for SPY, it doesn't look so bad. I mean, we're crossing above 20 again on the negative indicator, but we're still well above 25 on the positive. When you look at QQQ, on the other hand, that we have a very bearish pattern, breaking below 20, nearly breaking above 30 on the negative indicator, and of course IWM breaking back below 20, close to breaking above 30 on that one too. So those two indexes are pretty darn close to showing bearish directional moves on these charts, unlike what we're seeing on the S&P, which is really being heavily influenced right now by the Dow, which is still not even close to a pullback yet. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the right-hand corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. There's a bell next to that subscribe button, so subscribe and click that bell there. That notifies you when our videos are posted. Also, hit that thumbs up icon that's down below the video. That tells us two things: you liked our video today, and you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our videos. If you don't like our videos, of course, you don't have to click on anything. But if you watch them day to day, you like them, you want us to keep doing them, you want to let us know that with one click, that's what the thumbs up tells us. And we look at that every day. So we really appreciate those who do click on that. Also, comment down there. What did you get out of our videos today? Why should somebody else who's coming to you for the first time watch it? What would they get out of it? Post that in the comment section below. Subscribe to our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, come down here and click on some of these things over here on the right. This is the Market Outlook live video. Every day I do the Market Outlook. I do a live video at 3:30 Eastern Time. I actually got to go on today. It's had some technical difficulties here recently. But there's where we review all the old trade ideas. We actually made quite a bit trades today on some of the old trade ideas that we've talked about in prior videos. So if you want to check those out, click on that. Also, our trading rooms over here on the right-hand side. Click on View More right here if you want to see the rest of our calendar. That's also right here. There's our trading rooms calendar. All of our subscribers, all of our paid subscribers get access to all the trading rooms and the Market Outlook live videos. Of course, our premium subscribers get access to all the same stuff for a lot less per month. When you average it out, it ends up being a lot less per month. In addition to that, they also get all of our premium tools, as well as access to the class forums and the Q&A sessions. As you can see, every week we have a Q&A session. Brandon has one, and then I have one. Come down here, click on this heart. It opens up a new tab. Click this like button right there. Also click this icon. It opens up another new tab. Click that like button there. Again, the more you do that, it helps us out because more of our people who follow us will actually see our content based on how Twitter and Facebook works. They will push content out to our followers, the content that has the most engagements. So that's why we keep asking you. It also benefits you too because the Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at the weekly chart. Remember last week on the weekly chart for the S&P, it started to show a transition candle. In fact, we did get a transition candle. This week, we still don't have one yet. The open was at 41.78.10. We're only at 41.88 right now, so we still don't have a lower shadow yet. It is a very small body. The bodies for this, if you look at the Hakinyashi differential here, tells you the size of these bodies and whether or not we're going to cross below zero, right, which is what gets us to the bearish candle. And you can see that we've been gradually moving our way down towards zero. If I were to smooth out that purple line a little bit more than just 3 days, so like say, let's go 2 weeks here, you can kind of see that the bodies get really big. The bodies got big again right now. That's these bodies right here, as well as these at the beginning of this move. So when they grind, you can see how this is the intermediate pullback. When we get towards zero on that 10-day chart, there's the crossover. There's the intermediate pullback there. There's close to one on both of these where they got really close to zero. You might be able to even change this to another common time frame, like 7 days. And you can see the same thing here. Very close to zero on all of these, a little bit below zero, well below zero on these market sentiment declines. That's kind of the idea. But the regular candle, the regular time frame for this, the default is the 3-day, and we're headed back down again. Just like we were really close to one over here, a breakdown. And again, remember, that's the Nasdaq did get the breakdown there, so we did drop below and got the intermediate pullback there that we did not get on the S&P. You notice the Nasdaq is breaking down again below zero, so kind of shows what kind of pattern we're getting. And this is obviously after a relatively bearish transitionary candle last week. This is pretty much a bearish candle this week on the Nasdaq 100. The Russell 2000 showing very similar, like very bearish transitionary candles here, and you can see how it's been grinding down the purple line towards zero and looking for its own little crossover where it can get its own intermediate decline, like we see in some of these other areas where the purple line crosses below zero. Obviously, we're only 1 day into the week, so we'll kind of monitor that as we go about the week here. I showed you the DMI. If you look at the RSI, again, back below 60, that's not necessarily bearish. It just means that we're not strongly bullish anymore on the S&P. The NASDAQ 100, on the other hand, a little bit different, right? We are pretty significantly bearish. We are not significantly. We're a lot more bearish because we're closer to the bottom end of the neutral range and crossing below 40. That the CCI did drop significantly below 200. And then you look at the Russell 2000, you can see also the same thing. Lower end of this neutral range, lower end of that neutral range. Not bearish, but leaning more bearish than what we're seeing right now in the S&P 500. Take a look at some of these other indicators here, like the 3 green arrow chart, 2-line versions, of course. MACD and stochastic still falling below their moving averages, even though we're still kind of above the 8-day moving average there. Remember, the diamonds were well above the 8-day moving average, so not really bearish at all there, but grinding on the S&P. The Nasdaq's a different story. It's got above the 17-day briefly, or flirted with it on Friday, easily back down below it. Both the 8 and 17-day are crossing, which means the moving average here is about to cross below zero. The stochastics moving average is below 40 now. If you look at IWM, you can see the MACD is negative. We're well below the moving average here, more below it than what we've seen. Last time we got this far below, we bounced right back up, so keep our eyes on that. Moving average is closer to dropping below. The stochastics moving average is now no longer above 60, so that's a significant breakdown in terms of not being bullish and not having that bullish bias anymore on the S&P 500. One more thing here on the trend strength indicators, well above on the S&P, very strong bullish still, bullish trend. Not the case in the Qs, right? We don't have a bullish trend anymore at all. We're well below the blue line there. And then IWM, we're below the blue line. We're flirting with a very flat cloud and then no trend at all either. So you can see the relative weakness in these other two indexes that we're not quite getting yet on the S&P. But we all know that both of these two indexes have been leading the S&P at various points of the year. Now that they're both moving in tandem, you would expect that the broader market will follow those two leaders one way or the other. We'll see if today is just a one-off day of weakness or if it's going to end up being something more than that. Now let's take a look at the intraday chart for the S&P, and you can see the decline. But again, I mean, we talked about this on Friday. The faster it can go up here, as fast as it can go up on light volume, it can go down just as fast in light volume, especially in a intraday move kind of like this. But you can see there's some support here, so it's not like we're falling off a cliff. We're down just a little bit more in the after hours, but very, very strong support here. So take that for what it's worth. The Qs actually got a new low, so we got an Arun break on the Qs that we didn't get on the others. You can see the break there up to zero, but we see we've already gotten this break before, so it's relatively bearish. IWM, they're both going down here. Keep an eye on that negative indicator. Now it's going to be some time before it breaks up above, to a new low, but you can kind of see where it would have to get to for that to happen. Obviously, no new high. The highs are just going to keep moving over to the left. We just barely got a new high in the S&P. If we get a new low relatively quickly on the S&P, and the low point after today will move up to probably right around to that level there where my cursor is. So not much higher, but it's got to make a pretty significant move if we're going to get a new low that quickly. Those tend to be relatively bearish when you get a new high and then a subsequent new low that fast. But if you look at the volume today, take a look at today's trading range and volume. The volume picked up above 81 million shares. The trading range wasn't that big. It was just under 5 points. If you take a look at that move in context, just under 5 points is right up here, so it's above the average. 81 million is right there. It's also above the average. That will bring the ATR to price ratio up. You can see we don't have those big ATRs on here anymore, so it's kind of changed the scale. But still, there's the 1% mark. That's the important mark as we come back up here. Obviously, 5 points is above 1%. The ATR right now is 4, so 4.18 looks like the kind of magic number right now for today at least. That changes if we were to move around tomorrow in the price. That kind of gives you an idea of the kind of above average volume, above average trading range, and then now volatility also a little bit above. Now still, it's pretty much at the sweet spot for bullish. So like right here is actually kind of where the VIX kind of should be for this bullish trend that it's on. This is the sweet spot relative to the VIX 3M. So getting up to 19 is not that big of a deal, really, when you take a look at it from that perspective. Of course, it's the move up to above 100% that we start looking for the beginnings of an intermediate run. They don't typically happen from here, so we're probably going to get, again, another, a move maybe up to this 90, maybe up to 95% on any kind of near-term decline before we're done, right? So the near-term run that we're on right now has been, 1, 2, 3 days, maybe 4 tomorrow, because I wouldn't be surprised if we bounce back up. But we talked about the near-term runs will be more frequent. They'll be shorter and more frequent, but I don't think necessarily that we're ending. Obviously there are signs that we're towards the end, like we were in the later innings of this baseball game, but I don't think today was the last out. I don't think we're done with. I still think we have another small near-term run potentially left out of this, where the near-term line will pull back below 50, and then we'll bounce back up one more time. Maybe the next time we don't get above 80, and then we roll back over and start the actual exhale that we've been anticipating. And finally end the 6-month long. I mean, this is one of the longest intermediate rallies I've seen, and there's two. To have two such extreme bullish intermediate rallies back to back with about as weak of an exhale as you could possibly get in between. And there was some, pretty decent noisy moves that very well could have been exhales in between, were about as noisy as they could be without being, by definition, exhales. So, you kind of had slightly intermediate pullbacks, and then again, about as weak as an intermediate pullback as you can get, and by definition, still be actually technically be one. So I mean, really, this has been a very, very mature intermediate run. At some point in time, we're gonna make a move at least down to 4,000, because that's how things work. And the question is going to be whether or not people can handle that type of exhale. Can we handle breathing out without everybody thinking that we're dying? That's going to be the big question. All right, so to summarize the technical outlook, today was a pretty bearish day. There's, again, like there has been for about a week now, there's more signs that, we are leading towards an intermediate decline across all the indexes, and not just the NASDAQ this time. But we're just not there yet. It's a process. We're in the process. What we do know, according to the indicators, is we're just not strongly bullish anymore, except for the Dow Jones, which is still kind of hanging on. You can see where the strength of the market is at right now. We'll take a look at that rotation here in just a minute. But you can also see where the weakness is. Now, what's significant is now we're getting similar weakness in both the NASDAQ and the Russell, which have both been kind of passing the baton back and forth since the COVID low point on who's led the market. Now they're both moving in tandem, like both in the same direction, and they're both moving in a different direction than what like the Dow is. So it's kind of interesting that our two leaders are not leading the market anymore, but they are moving in the same direction by a significant amount, which tells me that, again, they're the ones to follow, and eventually the markets will follow where they lead, especially the NASDAQ 100, because that's where the large market cap stocks are. And then the Russell 2000, which has the most to lose, right? It's got the biggest gains since the Halloween low point, so it's got a lot of that it can get back over the next little bit. So not bearish, but not bullish anymore either, right? We're just still grinding towards the end of this bullish intermediate run. Lots of signs that intermediate run's ending, but it hasn't rolled over. We haven't started the bearish run yet. And we're kind of in that grind portion where you're just going up and down, making these noisy moves until you get another clear directional move. Which we expect the next clear directional move will be to the downside. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What indicator or charts are you looking at that suggests to you why you're a lot more bullish or a lot more bearish than I am? And share that with our market scholars community down below. Now let's take a look at this. Rotation, the sector rotation that we're getting. I've been showing you this chart lately that kind of shows a long-term trend of the rotation where XLI, XLB, they've been kind of the last laggards. They're the sectors that have really been going parabolic here. If you take a look at the sector rotation moves, the DMI charts, you can see XLB has gone parabolic. XLI has gone parabolic. So they're the ones, and that's just on the daily chart. Of course, on a weekly chart, they've really gone parabolic. There's XLI, and then there's XLB, right? So those are the sectors that are still kind of holding up. They've gone parabolic. We know at some point in time they will get back some of that, because that's what financials and energy, they were the ones, financial and energy, you'll see they had already gone parabolic. That's where they peaked. They've been pulling back since. That's energy. And then financials also peaked early, and we've been kind of grinding higher. This is the daily chart especially. You can see on the daily chart how those had gone parabolic here a lot earlier, right? So that's when financials went parabolic, and we've just been kind of grinding up since. And then energy, you can see when it went parabolic, and it's been kind of grinding up since. So that's why their rotation charts look like they're already rolling over in the long term. Materials and energy or industrials will be the next ones to roll over. You can see discretionary, technology, and communication services are already down. And then you see your safe haven areas moving up to the right. That's on the long term chart. But we're still in this mode on the daily chart where XLF, XLE, XLB, XLI are all making one last run where they're going up to the right. And they're going at a super fast speed. I mean, that is like ludicrous speed here that they're moving over to the right. Big, strong relative strength moves. Whereas XLY, XLK, XLC moving down to the left. XLV, XLRE, XLU, XLP also underperforming, moving down to the left. So we're still kind of, I believe, still in one last rotation before this trend takes hold, and we start to get more weakness in these areas. And you can see that in their 12 grid. Of course, technology. I mean, look at these areas, light pink shading with yellow lines on all of them, except for XLC, not quite there. But there's materials and industrials. You see how parabolic they've gotten, energy and financials to a degree. You see how parabolic they've gotten with long upper shadows and kind of a piercing line type pattern. And then there's your safe haven areas down here that are all bullish, and they're all just kind of grinding right now with really strong returns. Obviously not 20% like you're getting in energy and materials and industrials and financials, all 20% returns, flat returns in these other cyclical areas, pretty decent returns in these others, and you'd expect that they'll hold up better, as you can see from when you look at it on this chart. there they are. There's the triumvirate here, and if you go all the way back to that September 24th of 2020, since this whole thing started, you know, there's energy and financials returns. There's materials and industrials making one last push here. There's everything else to the downside. They've all been really lagging. The S&P itself has been up 30%, led by these small weighted sectors. At some point in time, of course, you know, we expect that they'll start to work their way over to the downside. In fact, already, really from this peak here in technology, so about 426. If you take a look from 426, which ended up being, what would that be? April, let's see, so it would be 2 weeks ago. So if we look at the last 2 weeks, so the 20-day, it would be the 10-day chart. The 10-day chart here, you can see technology and discretionary have been underperforming. The S&P has been flat. Those two have been down, and these four sectors have just had really, really good gains for the last 2 weeks. Now the question is going to be, when are they going to themselves roll over and follow suit with these large cap areas? And I believe we're in the process of that happening now. We're just not quite there yet until we start to see these on a daily chart start to move down, right? And we're obviously we're not there yet. If you take a look at this chart, QQQ and IWM, of course, when things do start to move up to the upside, this chart will start to move up too. I believe the Qs will start to outperform, so the MACD will turn back above its moving average. The histogram's already moving up, right? So you'll get the crossover. When the histogram goes positive, that's when we get the crossover here. You see the long-term PPO is still above its moving average. The CCI is moving back up. The RSI is kind of bottoming out here. Once they all start to move up, that's going to be, in my opinion, when everything starts to move down. Right, when these areas start to underperform, not because everything's going up and they're just not going up as much, it'll be because everything's going down and they're going down the most. If we look at from an asset class standpoint, you can see the inflationary trade, right, with real assets on top and long-term bonds on bottom. That's about it. And emerging markets not following with commodities. They're typically very closely tied unless we are in a very inflationary market. And then they're not, right? And that's what we're seeing here, what we're seeing today. If we just take a look just at today, so let's go over to May 10th, do a 10-minute chart. You can see, again, these two moving in tandem to the downside. Emerging markets still lagging behind and struggling. You can see long-term bonds following with S&P. So not really a big risk-off day, but it's an inflationary day. Gold is up, real estate is up, and bond yields are up. To show you what that looks like here on the bond yields chart, let's take a look at the TNX here, and you can see they bounced back up. Yields did. Short-term sentiment moving up higher. So what does that mean? TLT, remember, is actually the longer-term bonds. You see how they came back down, light pink shading, yellow line. So we'll see how temporary this pullback is. GLD is not giving us light pink shading. In fact, it really broke out. I mean, has taken off. A lot of that's been on U.S. dollar weakness. When the U.S. dollar here last week broke out too, all the way back up to this 23% retracement, which is an important level because getting back above that line will, basically start the new long-term trend for the euro to the upside, or in other words, the long-term trend for the dollar back to the downside. Very important level to watch here, especially with near-term or intermediate divergence setting up with lower highs and possibly higher highs. So very, very, and if you look at other indicators too at the same time, you can see lower highs on the RSI with the higher highs, and then you look at the MACD and the stochastic indicators, and you can see lower highs with the higher highs. So very important to see whether or not this resistance holds and the dollar goes down. Again, would be a signal of more of a risk-off, kind of a risk aversion type trade. When the dollar goes down, gold stays up, and long-term bonds bounce back up off of this three red arrow signal that it's getting right now, right? So 3 red arrows, light pink shading, yellow line you'd expect. And that's actually a bullish signal when we get that. We'll see if that actually plays out or if it ends up being the reversal sign, which I think is unlikely because I don't think long-term bonds are going to be dropping like a rock here. That would be obviously would take place in a significant risk-on market mode. And you remember we're already in a very mature risk-on mode. In fact, if you look at TLT here, you can see the risk-on move here. So it's a very mature. The PPO is very low. This is a very significant risk-on move that we've been in for bonds to be down this much. And you would expect to move back up to probably about 140, 149 in this area on any kind of broader risk-off move. For our trade idea of the day, one industry that's been kind of a persistent winner inside of the technology sector, which has been lagging, has been the chip areas. And a lot of these chip stocks are really breaking down pretty significant today. You can see Applied Materials closing down below all these lows today, dark pink shading and a red line. If you look at like the 3 green arrow version of this chart, obviously the 8 and 17 day moving averages are below the 30, and you can see the decline in both the MACD and the stochastic indicators. From a long-term standpoint, you can see the strength this sector has had, but still up above the 50-day moving average, with a converging PPO down there, really high PPO that's starting to converge. The RSI and the CCI don't show necessarily bearish signs yet, but relatively bearish from that perspective. And then you look at the DMI, and you can see the potential beginnings of a bearish directional move. But when you look at the Bollinger Bands, you can see, okay, well, we are still above the value area. There is some pretty decent support down below where we're at here, and a decent volume resistance above. We're kind of in the middle with this move that we got today, with earnings coming up before May expiration. So that kind of gives us an opportunity here to sell an iron condor spread in the middle of that range. So sell at the 20 deltas, so 140, buy the 145, sell at this 20 delta, be 115 by the 110. There's where our break evens are. We didn't go for a full position size because of the earnings. We're able to get a full return, a full maximum gain with less than a normal position size because of the earnings announcement. So you can see those break evens where they end up being on the chart. They end up being right there. So as long as we stay in this range, and don't break into the value area. And if we break into the value area, we'll take a small loss. But remember, we're hedged against that type of move. So we'll end up being okay. And more than likely, this really strong move will start to consolidate it. And I expect more into the sideways range, at least through June expiration, before more of a broader exhale comes. So that's kind of the trade idea of the day. Again, looking for not necessarily weakness in this area, but no longer continued strength in that area. So more of a sideways action within some area volume here and some area volume up here. And we just kind of stay up and down, but more in the middle now that we've had that significant move to the downside today. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Remember, all of our subscribers get access to that, including our free subscribers. So let's keep this conversation going there. Open up a thread, reply to somebody else's thread with everybody that watched these videos. Let's talk about what was brought up or any questions or comments you have. Post it, open up a new thread with that. Remember again to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook too, follow us or join our website, follow us on Twitter, join our Facebook group, comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.